exercise 8-9. You can see I put back up on the board what we did complete on Tuesday. So just to kind of give you a heads up, today we're going to wrap up purchases, or I should say, generally speaking, inventory transactions, because that's really what we're looking at in perpetual, periodic, and also gross and net methods. And so we got kind of different combinations of all of those things. Then we're going to head into inventory costing methods. So FIFO and LIFO again. We're going to come back to FIFO and LIFO. And then that'll be all we do today. I know, like, don't be disappointed now, but I'm probably going to let you go just 12:05. If I'm still yapping, somebody tell me, okay? Because I have somewhere I have to be by 12:15. So, and I gotta walk there. So, don't hesitate to be like.
You're going now. I don't want you to.
Oh, I don't need that long. That's pretty good, actually. Yeah. I do appreciate that. All right, so these are journal entries that, again, we've learned in the past. We're making some modifications to them based on the types of inventory systems that the company's using. So in this first one, it says on July 15th, the niche car company purchased 1,000 tires from the Treadwell company for $50 each. Terms of the sale were $210 net 30. These use the perpetual inventory system and the gross method. Okay. So it says, number one says, prepare the journal entries to record A, the purchase on July 15th, and B, the payment on July 23rd. So we decided that that payment on July 23rd was within the discount period. So what we ended up doing is on July the 15th, we debited inventory, we credited accounts payable. And then on the 23rd, when we go to pay the balance, what we're doing is we're satisfying the liability in full. So we get to clear out all 50,000 of the accounts payable. Our cash, however, is going to be 2% less than the full purchase price because we got to take a discount. So 100% minus 2% is 98%, right? So our cash is 50,000 times 98% if you want to look at it mathematically that way. The discount gets credited to inventory because hopefully you remember that in a perpetual inventory system, we're adjusting all transactions through the inventory account. I drew that T account up here on the board on Tuesday. And so the credit, 50,000 times 2%, that's our discount. It gets credited through inventory. So that's if we make the payment within the discount period. Now, number 2 says prepare the journal entry for the payment, assuming instead that it was made on August 15th of 2024. So what does that mean? In other words, made the purchase on July 15th, but we're not making payment until next month. So what does that mean? What did we lose? We lost the discount. Yeah. So we're just paying the full price, right? So in this case, we debit accounts payable and we credit cash for 50,000. Now I'm going to come back to number 3 after I do exercise 8-10. The side-by-side one and number 1 and 1 and 2 because I want to keep them side by side. All right, so we're going to come back to number 3, but I'm going to jump over to exercise 8-10, which is basically the same set of transactions, but in this case we're using the net method. So this was perpetual gross method. Okay, and that means that we record our purchases at the total inventory amount. We only record the discount if we actually take the discount. Okay, perpetual, we use inventory as our account. So there's kind of a lot, I guess there's kind of a lot to remember, but that's why we're going through this, trying to go through this slowly here. What is this skip counting 201 day or what? Guys, did you guys not get the memo, or did you just decide not to be followers and to be leaders instead? Okay. Now, it says, exercise 10, this is a variation of exercise 9 modified to focus on the net method of accounting for discounts, purchase discounts. So if we read through that, it's the same information, but the last sentence says, Nixon uses a perpetual inventory system. So we're still using perpetual here. Okay, so this is still perpetual, but in this case now, this is the net method of recording, which means that we actually record our purchase minus the discount right up front. And then if we don't take a discount, it's a discount loss, but you'll see how that works. So this is supposed to be side by side. It's the best I can do. Sorry, it's not really all that side by side. But 1 and 2 match up here, okay? So hopefully you have your calculators handy because you're going to need them today. You do lots of calculating today. I even have a little worksheet paper for you. Doesn't that sound exciting? Woohoo! All right. So if we're using the net method and we're recording the purchase of inventory, 1,000 tires at $50 each with a discount of 2%, the net method means that I'm going to record this inventory at what amount? Yeah, the discounted amount. So how much? Well, 50,000 times 98% is what? See, this is the difference between, so I like to show this side by side. This is the difference between the gross method and the net method. And actually, you guys learned this in chapter 7. There were 2 questions on your exam. Speaking of, I will be giving those back next Tuesday. I have 3 exams I have to pick up today at the testing center. And then I'm all caught up with the exams. You will get those back in class on Tuesday. Well, too bad. Got to face the music. Got to face the music. Hey, listen, there were quite a few A's and there was 100%. So I will not say any more. I won't say any more right now. All right. This class is not supposed, it's not supposed to be easy. This stuff's not easy. I mean, that is just what it is. It's not easy. So, no. No. Oh, actually, you know, at the end of the year, you get, or at the end of the semester, you get bonus if you don't have any unexcused absences. If you have excused absences, you still get bonus, but, you know, if you don't have unexcused, what's that? Yes, I just got the list this morning of who attended mentorship day. I got to figure that in. Yeah. I didn't have the list before this morning, so I got to take a look at that. I'll do that over the weekend. You just try now everybody's like, what points can we get, right? And again, you guys got a couple of questions for target case. That'll help. There'll be a quiz. That'll help. It'll be all right. It's just one test, but talk more about it. All right. So on July 23rd, making payment within the discount period. We already took the discount, right? So this journal entry is pretty straightforward too. It's a debit to accounts payable for $49,000 and a credit to cash for $49,000. So side by side, it helps to sort of understand the differences between the two. And listen, folks, look, perpetual means that we use inventory for everything. Okay, that's what perpetual means. If this was periodic, who can tell me what account name I'd be using? Oh, we're going to talk about that in number 3. You guys remember from Tuesday? Nope, this is purchases. Yeah, purchases. We'd be using purchases. Thank you. All right, so anyway, now let's assume number 2, if we're using the net method and we fail to make payment on the 23rd. Instead, we make payment on August the 15th. What are we losing? We lost the discount, right? But the thing is I never actually, I already took out the discount as if I was going to make payment within the discount period, and now I haven't done that. So, anybody know what I might have to do here? Because how much cash am I going to have to pay out? I'm going to have to pay the full amount, which was what? Okay, so I do have an accounts payable, which is how much? How much is the balance of my accounts payable? It's only 49, right? But my cash is how much? 50. I got to leave a space here for another. You guys remember what we call that? Yes, I'm not selling, I'm buying.
Sales discount forfeited.
Not selling. Yeah, purchase is discount. So, Sarah, is that what you were gonna say? Yep, so we got a purchase discount lost. It's a lost. And that's really like, in this case, it's kind of an expense, but purchase discount lost $1,000. Yeah. Okay, now we're going to redo all these entries, assuming a periodic system. So you probably need you're going to need a fresh page maybe. I'm going to erase some stuff so that I can save some time here, but you guys ready? So requirement number 3 in each of these questions says, go back and explain the differences. Well, I like to show the differences rather than just talk about them, because we talk about them, I need a visual, right? So we're going to go back and we're going to redo these exact journal entries, assuming not perpetual, but periodic. And I am going to, what I'm going to do is, if I can find a different color marker up here, I can. I am going to put the different account names in a different color. I'm going to do it that way. So that you can kind of see, and you can obviously do what is best for you, but I'm going to try to make the adjustment next to so that you can see which accounts change. So if this was, actually what I'll do is I'll just erase and substitute. All right, so periodic, we are not keeping track of our inventory continuously. That's perpetual, right? Perpetual is ongoing. And when I have a perpetual inventory system, I adjust everything through inventory. Remember the T count I put on the board and all the different expenses that can impact inventory, discounts, all that good stuff. But if we're doing a periodic, we're using periodic, then I don't put a balance in my inventory until the end of the year when I physically count it. So throughout the year, I'm using temporary accounts, purchases, discounts, those types of things. So if this was periodic, I would not be debiting inventory, I would be debiting purchases. You guys should have some of these notes from the other day, or PowerPoints, you could look at those. So instead of inventory, I use purchases. Okay, so anywhere you see inventory, you got to get rid of it, because this is a periodic system. Can you guys see that? Purple's not very bright, is it? I was hoping it would be a better purple. And instead of adjusting for the purchases, what account do I use? Here. Because remember, I had written it on the board, did a formula on Tuesday where I showed you cost of goods sold, and then I could have did a little extension with purchases and how we get to net purchases. This is a what? Somebody wrote that down. Isn't that a discount? Purchases discount? We got to replace all of the inventory words with those temporary accounts purchases. And would anything change with my last entry? No. There's no inventory in there, right? Okay, so if I'm then doing periodic, this inventory becomes purchases. And then we're going to look at one more example in the PowerPoint so you have another reference. So purchases, right? No inventory in the July 23rd, right? And I don't have inventory, but I have this purchases discounts lost. some time to get all that written out. Interestingly enough, this is actually the same account, but I wanted to write it in purple because that you could see what was different with each exercise. So again, keep in mind, perpetual is inventory. We use inventory. The inventory account. Periodic, we're using purchases and it's temporary. Actually, in perpetual, we're using inventory and cost of goods sold. We didn't have any sales transactions with this one in particular. But under periodic, we're using purchases, purchase returns, purchase discounts, and no inventory, no cost of goods sold until the adjusting entry. And again, perpetual meaning we always know it's an ongoing balance, a running balance, how much inventory and cost of goods sold we have. We update it after every transaction that affects it. Under periodic, again, it's what it sounds like. We periodically know how much is in inventory and cost of goods sold at the end of the year, particularly when we do the adjusting entry. The gross and the net method refers to how we account for potential discounts. The gross method, we account for them when we actually take them. We don't assume we're going to take them, so we record at the gross amount. The net method, we assume we're going to take them, so we record our purchases at the net price. And then if we don't take the discount, it's a discount lost. So I know it's a lot to keep track of. I do understand that. So we're going to look at one more example before I move on to cost flow. Assumptions. And I'll show that to you up here. And the reason I'm showing this to you, and I would pay attention or at least make a note of where this is in the PowerPoints. This is like a summary of a variety of different transactions. Your graded homework assignment starts out like this in this chapter, okay? So these are inventory transactions, both perpetual and periodic, hence the side-by-side kind of help up here, but there's also some great examples on the next few slides. The Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. So again, guys, you got to think, am I the buyer or am I the seller here? Those are the questions that you're asking yourself. You have to know what role you're in when you're recording the entry. And we're still kind of sometimes getting confused, am I buyer or am I seller? You are both, but it just depends in a particular transaction, what are you? You've got to be able to identify that, right? It says the company began the year with $120,000 of inventory on hand. During the year, additional inventory transactions include. So we have the purchase of inventory on account, $620,000, terms 210, net 30. Freight charges that were paid by Lothridge were $16,000. Inventory with a cost of $20,000 was returned to suppliers for credit. So Lothridge returned some of their stuff that they bought. All purchases on account were paid within the discount period. So this, look, the first 4 bullets, 1, 2, 3, 4, all Lothridge is buying. These are all buyer transactions. And then obviously Lothridge is buying to turn around and do what? To sell them to their customers. So then starting here on sales, the last 3 bullets are sales transactions. Sales on account were $830,000. The cost of those soft drinks that were sold, $550,000. You know what that means, right? They sold $550,000 worth of soft drinks. They charged their customer $800,000 for those. Inventory remaining, well, these two are sales, I jumped ahead of myself. This one, inventory remaining on hand at the end of the year is 174,000. This is the physical count. This is what the physical count results in, okay? So it says the above transactions are recorded in summary form according to both the perpetual and periodic systems using the gross method. So we're just focusing on the gross method in this example, but we're going to do both side-by-side periodic, perpetual periodic. Now, does everybody know what it means? And I've explained it, but you know, you guys are all like my husband, you don't listen. Summary form. Summary form, unless I say beer. Then he's like, what? Where? What? Where are we going? Beer. Summary form. You guys know what I mean by summary form? See? A couple of you are like, wait, that's the first thing I've heard her say in the first 20 minutes of class already. Right? So, summary form. In other words, we can't obviously record every individual transaction throughout the year. So, this is just the total. We're making one summary entry. If there were 50 sales transactions throughout the year, they would all be the same debits and credits, right? Just making our life a little simpler by doing one summary entry. So let's take a look here at the illustration. So what we have on this next slide is we actually have the side-by-side journal entries, perpetual, periodic, but both gross. You can ignore net, right? We're recording it gross. So, and notice here, this says in thousands. Somebody tell me what this means. We see it frequently on financial statements, Dan.
Like that 620 would be 620,000.
Yeah, we're dropping the zeros. Why? Because they're crowding the little page here, right? We don't need to see them. And again, you got to pay attention in financial statements. Almost every financial statement that you pull up online and look at, none of the zeros are there, right? There are millions, billions of dollars. Nobody wants to see all those zeros. So you got to pay attention so that you know how to read this. That's 620,000, right? So, okay. So in a perpetual inventory system, like I said, we use inventory and cost of goods sold. Under a periodic, we do not use those terms until we do an adjusting entry at the end of the year. So on the left, we've got a debit to inventory, credit to accounts payable for the purchase of inventory for $620,000 that this company plans to turn around and eventually sell, right? If they were using a periodic inventory system, inventory becomes purchases instead. So it's a debit to purchases, a credit to accounts payable. We go to the freight, and since they're paying for the freight, that tells me that they're responsible for paying it. They can include it, if it's the perpetual system, they can include it in the cost of inventory. Perpetual, again, we use inventory for everything. Freight, insurance, discounts, all of it. Returns, everything gets adjusted through inventory. So in that second transaction, a debit to inventory, now it said they paid cash for the freight because they pay the carrier directly, and the credit to cash for $16,000. Under a periodic system, I didn't write that over here and I should have. Freight in, I forgot, sorry. Freight in is another temporary account that we use, which describes the cost of our purchases, right? So, not inventory, we don't use inventory in periodic. So it's a debit to freight in and a credit to cash, okay? Then we have returns. And in the case of the perpetual, it's just the reversal of what we did when we bought the inventory. So we do the exact opposite. We debit accounts payable to lower the balance of accounts payable. We credit inventory for $20,000. Under the periodic system, we don't use inventory at all, not the account. We debit accounts payable to reduce it, but we use purchase returns as our credit to offset the purchases account. Notice purchases is a debit, right? Purchase returns is a credit. That's 620 minus 20. That's offsetting that purchase. Okay? Everywhere you see the word inventory, under perpetual, under periodic, you substitute one of those purchase account names. Right? And then the payment is made in the discount period. That's what it said. And so under a perpetual inventory system, we're going to debit accounts payable for $600. Why $600? You're all zoning out. See, we should be keeping T accounts, right? Accounts payable started out at $620. Then we had a return. So what's the balance? Balance is $600, right? You don't want to pay for more than what you kept. So the accounts payable is $600. You get a 2% discount on that. 2% of $600,000 is $12,000. So the difference there is the cash payment of $588,000, right? And again, the discount, look, that's adjusted through inventory. All right? These are just purchases. We didn't get to the sales yet. Got to remember what your role is in all of these journal entries. So these are purchases. So when you make a payment within the discount period, you have to reduce your inventory by the inventory value by the amount of the discount. Over here, excuse me, same idea, but we don't use the word inventory until we get to the adjusting entry, and so our credit is to purchases discounts instead. Okay? So I love the side-by-side comparisons. We're not done. We still have a couple more entries on the next screen. I love the side-by-side comparison. This is very helpful. It will be helpful to you as well in graded homework. Come to the next slide. Now we do the sales. Now, in the perpetual inventory system, remember, we're always keeping track of inventory and cost of goods sold, like I wrote up there. So anytime you have now we have sales, you got to record your expense associated with the sale. Your expense is what those goods cost you. So we always have two entries. One to record the revenue, so the debit to accounts receivable, the credit to sales revenue for $830,000. The second entry records the expense, the debit to cost of goods sold, the credit to inventory for $550,000. Okay? This is the expense. This removes the item from inventory. Over here, why do we only have the sales entry? Why do we only have the entry to record sales? No entry here. Why not? Because what did I say over here? We don't do any transactions that impact inventory or cost of goods sold until we do that final adjusting entry at the end of the year. So we don't keep track of cost of goods sold. Notice this, at the end of the period, the perpetual system doesn't require an adjusting entry because we've been keeping track of inventory and cost of goods sold the whole time. We don't have anything to estimate or figure out. We've been keeping track all year long. Under the periodic system though, we haven't. So now we got to go do a physical count. And even though we do a physical count, regardless of which system, the physical count here is necessary for us to do this journal entry. The physical count over here would only tell us if we have to adjust our inventory for shrinkage, or maybe the inventory balance is off because there were a couple broken things on the shelf that we had to remove, right? But we're not doing a physical count over here because we need to do this journal entry. We're doing the physical count in a perpetual system to verify that our computer is accurate with what's actually in our store and on our shelves. But over here, what happens is you got a whole bunch of things going on. So let's kind of look. So here's where I would start. If you guys want to pay attention. If you go back to the beginning of the information, it says beginning inventory was 120. Okay, I want to remove that because I want to replace it with the current ending inventory. So I credit inventory. I close out purchases, freight in, purchase returns, and purchases discounts. So if I go back through the transactions, whatever I did to those accounts, for example, I debited purchases in the very first transaction. To close it out, I would have to credit it. That's why purchases is credited here. When I paid for freight, I debited freight in. I closed freight in by crediting it, right? We had purchase returns and purchase discounts, which were both credits. Close those out, I have to debit them, right? The other thing that I was given was ending inventory. I was told ending inventory after physical count was 174. So I debit inventory for 174 because I took out the beginning balance. I'm replacing it now with the ending balance. The only number that I'm using, a plug number, I'm using a mathematical calculation to find is cost of goods sold. And it has to be whatever makes my debits equal my credits. Or you could go back to the formula which I gave you on Tuesday, which said beginning inventory plus net purchases is goods available for sale minus ending inventory is cost of goods sold, which is essentially what you would be doing, the math you would be doing here to find that out. Okay, I know it's a lot, right? Which is why we have examples. That's why we have examples. I don't expect you at all to memorize any of these things. All right, questions? So tell me, and we already talked about this, so somebody should know this, right? What has made it easy for companies to use the perpetual system? Because most companies are going to use the perpetual system. Technology, yeah. When you see computers and scanners, all I have to say is the word scanner. Something is being scanned, perpetual, right? Again, very few places are using, you know, old time ways of bringing up sales and things like that.
I know some places, like you mentioned before, some small like mom and pop
Yeah.
shops, like I think one flower place I've been to, like
Yeah.
still.
There's probably quite a few. I think what places like that do is they have to weigh the cost versus the benefits. And, you know, if you're this little store or your little pizza shop, like we keep talking about Vito's, I hope they appreciate how many shout outs I give them. You know, when you talk about a little place like that though, to implement the kind of technology that, you know, we're talking about for perpetual would cost them more than any benefit they would get from it. So now if they wanted to expand and open a whole bunch of pizza shops in the area, that might be different, right? But we're talking about one little location, probably not worth the cost or the expense. All right, you guys have any questions before I move on? All right, so I'm watching my clock, see? Checking my watch for you guys. So inventory cost flows, before I even get into, you know, the nitty gritty of this, we studied inventory cost flow in Accounting 101, and I know it's a long time, so you're like, well, I don't remember, but let's talk about what that means. Inventory, obviously, the goods that you sell, cost flow. So how they flow in and out of your store. So I like to think of whatever, I go grocery shopping a lot, so that's probably the first thing that I think of. But what I think of is if I'm a grocery store owner and I'm stocking shelves, right? Give me some things that I would consider as I stock the shelves in my grocery store. What would I think about as I stock them? Expiration dates, yeah. Sarah, is that what you were going to say?
I would think of like if it was like the 4th of July, we were going to talk about.
Oh yeah, so you're also thinking seasonal, right, and the amount. But in both of your examples, you still brought up something perishable, right? Something that has an expiration date, you know. And if you're at any grocery store when they're stocking, and you pay attention, and maybe you don't, but if you pay attention, like the bread guy. The bread guy is pulling all the bread off this shelf that's already existing there, isn't he? Well, he should be, and they do. Why? Because he's putting all the fresh bread, the new bread, in the back, isn't he? And he's putting all the bread that was already on the shelf in front of the fresh bread. Yes? And the milk coolers, right? And wherever the milk, the juice, and all that good stuff, the tea. Well, how do they stock those? You don't see people standing in front of the cooler door where you and I pull the gallon of milk out. They're behind, right? They're in the back, pushing all the milk, the juice, the tea, whatever, to the front, putting all the newer stuff behind. Why? Well, because they want you to take the older milk, the older tea, the older bread, okay? Then someone like me comes along. Guess what I do? I reach behind, yeah. I reach in the back and I grab the milk that as far back as I can reach. I don't know why, because it's not it's not like it's gonna spoil before it gets used in my house. I really don't know why I do that, but I do it. The bread, I do the same thing. I reach behind, right? So there's nobody at the store telling me, no, you can't take that fresh. You gotta take the old bread, is there? But the store, and there's nobody there because that's ridiculous. The store, though, has to make assumptions about the way that their goods flow out of the store. Now, the reason that we have this conversation is because prices change, right? If prices never change, I would not be having this conversation. So I want to explain to you, though, what the focus is and why it matters, because this is, I think, where we as teachers lose students in this conversation about this cost flow stuff and why we need it in the first place. When I sell something in a perpetual inventory system, I just went past that slide, so this should be fresh. I'm going to debit accounts receivable, and I'm going to credit sales, right? And the second entry is the debit to cost of goods sold and the credit to merchandise inventory, okay? You guys with me? It is this entry right here. I'm just dying to use another color marker here. It is this entry right here that forces me to pick an inventory cost flow method, such as FIFO or LIFO, because this cost of goods sold can vary for me. And here's what I mean by that. If I have a small grocery store and let's just talk about milk, because that's the easiest thing, right? I have a little grocery store, and it's Monday, and the farmer comes and I get a shipment of milk, I get some gallons of milk, and I pay the farmer $2.75 a gallon on Monday, and he comes back on Thursday, and now that same gallon of milk, 2% whole milk, whatever you like, take your pick, I don't care, is now $2.90 a gallon. Okay? And then he comes back Friday because it's the weekend and you've got people grocery shopping on the weekend, and now that same gallon of milk is $2.95. Okay? That's what I'm paying for it. I'm the grocery store owner, right? When I turn around and I sell my milk, my sales price, I'm just going to say, is $5 a gallon. I feel like that's close enough. Okay? So hear me out, right? When I go to record sales, my sales is easy. It's $5 a gallon times however many gallons I sold, right? But when I go to record my cost of goods sold, this is my cost, is it not? And I have 3 different prices now. So how do I come up with this number if I just paid 3 different prices? Well, I have to make certain assumptions about the way that the milk flowed out of my store. Since milk is perishable, what do I assume happened? No. What do I assume about how it was purchased? Let's say it's Saturday. Yes, go ahead.
Would it be like a LIFO system?
Not LIFO, go the other way. FIFO is what? First in, first out. So if it's Saturday and people are grocery shopping, right? It's Saturday morning, people are grocery shopping. I'm going to assume that they take which milk first? Because the way it's going to be shoved into my cooler is Monday's milk, followed by Thursday's milk, and way in the back is Friday's milk, right? So let's just say I only sold 1 gallon. Let's say these are, 1 gallon. Then my cost of goods sold, if I assume FIFO, is $2.75. You see? But what if I use LIFO, which I wouldn't for perishable goods? LIFO is what? Last in, first out. What do I assume?
That the last thing that you put the stock is
That this is $2.95. Do you see how this number can change?
Isn't there also average?
There is average, yes. There's actually quite a few methods. There are quite a few methods, and I will get to those. But I have to make certain assumptions about the way my goods flow from my store, even if they don't actually flow physically in that order. Because, again, I might be the person that comes in and I grab Friday's gallon of milk, I reach in the back and I grab it. The store owner is still going to assume I bought Monday's. Because certainly nobody could stand around and monitor how people were pulling things off of shelves, right? That's the reason that we need inventory cost flows. And I mentioned FIFO and LIFO, there are others. If the price of things never ever changed, we wouldn't need this, but that's certainly unrealistic, right? Take gas prices, for example. They change every other day, for crying out loud, practically, right? So how in the world do we keep track of what's the price of the gas that I sold Tuesday versus the price I sold Friday? I gotta come up with this number. How do I do that? Well, we do that by applying these cost flow methods, right? This is the journal entry that requires all of this analysis of inventory. Does that make sense? Hopefully a little bit. Okay. So basically what we do is we start off with a set of data. So let's take a look at the data. And it's similar to kind of like what I started here, really. We start off with a set of data where we keep track of units and price. Okay, so it says the Converse Company inventory information for 2024. And so what we have beginning inventory and we have purchases throughout the year. So pay attention. So beginning inventory, 4,000 units. Where did that come from? If you're starting January 1 with 4,000 units, what is the assumption? That you ended the previous year with 4,000 units that you didn't sell. You're gonna try to sell them this year now, right? Look, and the unit cost of those was $5.50, okay? So we keep that unit cost attached to that for a total value of those units of 22,000. Then we make some purchases throughout the year. This obviously isn't something that we sell frequently because we have 3 purchases. We have got one on January 17th, one on March 22nd, one on October 15th. What do you notice about the prices though of that good? The increase. What do we call that? We call it inflation. Exactly. That's what it is. It's inflation. If you start digging too much, you start thinking about how things have increased in price over the last 2 or 3 years, you get depressed. Don't do it. Like, things like just normal staples and food that you buy, and even gas, right? It's depressing. But same items, different price. So went from $6 in January to $7 in March to $7.50 in October, okay? So we add up all the goods beginning, look, this goes back to the formula that I had on the board on Tuesday. Beginning inventory plus purchases. Only in this case, we have to keep track of both units and costs. So beginning inventory and units plus all the purchases gives us 11,000 units total available to sell. When we do the math, 4,000 at 550, 1,000 at 6, 3,000 at 7, 3,000 at 750, and we add these up, the total value of the inventory of those 11,000 units is 71,500, okay? Now, also throughout the year, we have units sold. So we kind of have to find a way to kind of intertwine this, right? Because these are just purchases, and then down here we have sales. And we want to go in chronological order. So we had a sale on January 10th, which actually came before our first purchase. We had a sale on April 15th, and then a sale on November the 20th. Total sales were 6,500. So if we just look at the sales in total, we had 11,000 goods available for sale. Excuse me. We sold 6,500 units. So that must mean we have how many left? What's 11,000 minus 6,500? 4,500 units in ending inventory, right? Look, I have to give a value to the cost of goods sold. These are the goods sold. So do I say they're $5.50 or are they $6 or are they $7? It depends. What's it depend on? It depends on the assumption I make about the way they flow out of my store, right? So we have basically 4 types. So basically I already said all this right here. Sorry, forgot about this slide. Okay, so what we're solving for, though, is we're solving for the dollar values of these units. We just said we sold 6,500 units. We have 4,500 units in ending inventory. Question mark, what dollar value do I give those? And that's where the cost flow assumption comes into play. The cost flow assumption is going to tell us which items flowed out first, and that's how we're going to assign the value. Okay, so we're going to figure this out here. We've got 4 methods. I'm only going to do 2 of the methods. I'll talk about the other 2. Specific identification. I like giving examples of industries that use these methods. So specific identification is exactly what it sounds like. We actually can keep track of the individual units as they come in and as they go out. Automobiles, right? This is a perfect example. Have what we call what's the unique identifying number for a car? What do you call it? It's a VIN. Vehicle identification number. You guys know that? You know what a VIN is? When you get in your cars, there's a VIN number. It's like embedded in your dashboard, right up above your steering wheel, sort of. And it's also on the sticker and the door. Okay? Your vehicle identification number. No 2 are identical. So even if I sell cars on a lot, I mean my car's there's like a million of them out there and it's silver. Like, everybody has the same car as me. So if I were looking at my car on a lot of a whole bunch and they all looked exactly the same, all the same color, they're still not 100% identical because each one of those has a different VIN, a vehicle identification number. So you go out in the lot and pick one, right? And the car dealership can say, well, that particular car, a CRV silver car, came in at this price, and I can remove it at the exact price that it came in at because I know that value is attached to that VIN, right? So it's very unique. Jewelry is another probably example I could give you of where specific identification might be easily applied. Could you use specific identification in a grocery store? No. That would mean that every single gallon of milk would have to have its own unique identifier. Sounds ridiculous, right? Can you imagine a hardware store trying to use specific identification?
That screw number 400.
Yeah, that's right. See, exactly, right. So, we have the three that are most common. Okay, three that are most common. Look up here. Average cost, first in, first out, last in, first out. I'll give you a couple of good examples. I was actually talking to Ms. Dunlap about this before class, because we always like to sort of see if we're on the same page. And when I say average cost, what I think of is like, okay, whatever it is I'm buying and selling, it's too difficult to keep all the units separate because they all mix together. So she and I was talking about oil and gas, right? When, like, if you go to Sheetz, and have you ever been at Sheetz or some other gas station where the tanker truck is there to fill up the big tanks underground? Because isn't that where your gas is coming from? An underground tank. And they take the cap off, you know, the big giant screw caps off, and they stick their hose in there, and they shoot the gas down underground, right? Well, I'm sure there's still gas in there from the last time they delivered gas. The old gas is mixing with the new gas. Is it easy to keep track of what the old gas is and the new gas? No, it's all mixing together. So what we do is we just average out the price in that case. Oil, like big oil vats and things like that, people are filling up with oil. The old oil is mixing with the new oil. You cannot keep track of it in a per unit, so you do an average. Doesn't get applied that frequently. Okay, so I mention it, but we won't practice it. We will practice FIFO and LIFO because these are the two most popular. FIFO, first in, first out, perishable goods. That's an easy one. You want to sell, right, your oldest stuff first. First in, first out. So grocery store, great example. Last in, first out, non-perishable goods. I worked at a hardware store. I told you guys that. I worked at a hardware store, and when we would stock shelves, like nothing is spoiling for the most part in a hardware store. So when we would like fill something up, we just, I call them pegboards. I don't know what the actual real name is. When you hang stuff on them, like you hang things like a package of, I don't know, like a screwdriver or something that has a little tag, you can hang it. We didn't pull all the old stuff off. When we were stocking, we just slap it right over top the old stuff. It's a screwdriver for crying out loud. It's not going to go bad, right? So last in, first out is the last items that I purchase are probably the first ones that I sell. Those are the assumptions we make. Now, again, I go and I buy something like that that's like packaged, that's not going to spoil, and I look for the package that doesn't have any dents on it because I'm OCD. And not everybody is like that. So I'm like, oh, this box is smashed. I'm going to take the one that's behind it because I don't want a smashed box, even though when I go home and I take it out of the box, I'm going to smash the box and rip it up and throw it in the garbage. Like, it doesn't make a whole lot of sense, but this is a little bit of an insight into my brain, which maybe I shouldn't give you that. But anyway, it doesn't matter how things are actually pulled off the shelf. It's the assumption that is made. All right, you guys okay so far? All right. So we got periodic, though, and perpetual. And so periodic you guys learned in Accounting 101. Who remembers it? Nobody? A little bit? Okay. So here we go, folks. Look up here. Oh, that's not what I want. Wait, I'm skipping weighted average. Sorry. There we go. First in, first out. All right, so this should look familiar because we just talked about it, right? We had, what we assume is that the first units that were purchased are the first units that get sold, right? So if there were 6,500 units sold, then we assume we started off and we sold these 4,000 units first. So now they're all gone. And the price of those units was $5.50. Then we assume we sold all 1,000 of these units at $6 because that only adds up to 5,000, and I need my total sold to add up to 6,500. That's what was sold. So then we say from the March 22nd purchase that 1,500 of those units were available or were sold. Excuse me. Now, if you go back and you look at the original slide that has data on it, there were 3,000 units purchased on March the 22nd, I believe, right? Because there's still 1,500 left over. Didn't sell them all. right? You got 11,000 units total available to sell. You only sold 6,500, so some you did not sell. So we're trying to identify as which units got sold. So if we go in chronological order, which is what FIFO does, first in, first out. First in, first out. First in, go to the next one, right? Until our total units sold add up to, in this case, 6,500, the total units sold. Do the math, the dollar value of the units sold is 38,500. What's left over? Well, there was 4,500 units remaining in ending inventory that we did not sell. So that must mean that we didn't sell all of March 22nd. 1,500 of those still are left. We paid $7 for those. None of the October 15th units were sold. That's the assumption we make. And there were 3,000 of those at $750. Okay, for a total of 4,500 units. And it doesn't give us a dollar value on this slide, so let's go one more. There we go. The ending units are worth 33,000. Now, you want to know the great thing about periodic and perpetual FIFO? Somebody want to guess? Somebody wants to take a gander? You don't need a worksheet for this. The worksheet I have for you is for LIFO, but probably won't get to it today. But the nice thing about FIFO, periodic and perpetual, is that the end result's the same. They're not different. They're no different because you're going in chronological order. So, with that, I think I probably, and I'll show it to you, but I don't want this to scare you. This is perpetual. So this is like taking and evaluating every transaction chronologically. All right, so we put them all in chronological order. So in other words, what we do is we start with the beginning inventory, but we take our transactions, both purchases and sales, and we go chronologically. So this was a sale. This was a purchase, this was a purchase, this was a sale. You see it says purchase, sold, balance, right? And I changed the word. Here, I'm going to show you the worksheet that I have for you. I changed the word of the middle column from sold to cost of goods sold. It's the same thing, but I prefer the phrase cost of goods sold because what is the journal entry that's forcing me to do all this work again? The debit to cost of goods sold and the credit to inventory. This is the front and back. We don't waste paper. Yeah, so that middle column right there, look up here, guys. This is my transaction where I sold something. These are the numbers that I would use in this second part of this journal entry. Now, I don't have enough information to do this first journal entry, but every time I sell something, I have 2 entries in a perpetual system. This middle column is my cost of goods sold entry for that date. That would be this journal entry. Okay? Make sense? Sure? Notice that the cost of goods sold here, 38,500, and the ending inventory balance, so this would be like if I kept a T account of my inventory, that's what this is reflective of. This is my inventory balance. If I kept a T account, my T account balance at the end would come out to be 33,000. Okay? This is my total cost of goods sold, but I have entry at each of these dates. These are all purchases of my inventory. So all the journal entries we just did, the purchases and the sales, these are all the numbers for those journal entries. That's what the inventory cost flow system generates. It generates the dollar values for the journal entries that we would do in this system. Let me go back a slide. Look, cost of goods sold, 38.5, ending inventory, 33. 2 different approaches, same result for both periodic and perpetual. So I want to show you, I want to do one here quickly. Not quickly, but we still have what? I have 10 minutes. Okay. I'm watching the time, I promise. Okay, let's take a look at, and I kind of make up my own things as we go here. I'm on page You guys are going to do this with me because this is the only way you can learn how to do this, is doing it. All right, exercise 814, page 439. And you're going to need this paper. Okay? You pick a side, it doesn't matter. All right, and I'm going to try to show you this as we do it. It's not going to be easy, though. So basically what we have here is we have a list of transactions just for the month of August, right? Inventory on hand, that's what we're starting the month out with. $5.30 cost. You guys got to pay attention to this too. Please listen to me carefully here. You got to purchase, and then it says sold, 6,000 units for $12. $12 is the retail price. The retail price goes nowhere on this form. The retail price would only show up here. This is the retail price. This is the cost. There's a difference. The retail price doesn't go anywhere on this form, okay? And so let's see what we got going on here. We're going to use this inventory sheet. It's going to help us out. And this is exercise 814, and this is FIFO. Okay? So we're going to start out August 1st. That's the date, obviously. I don't care how you write the date. You want to put a year, you don't have to put a year. That's fine too. And this is not a purchase. This is not a sale or cost of goods sold. This is simply just identifying the balance of inventory that we have available. So it says we have 2,000 units at $5.30. So I want you to tell me, and I need my glasses now. You guys have calculators? You need calculator. Get your calculator out. Yes. So the balance is 10,600. Okay? So let me, this is going to be kind of challenging because I want you to be able to see the purchases, the sales, but I also want to keep, you guys can see that okay? I hope so. Anyway, on the 8th, the next one is the 8th. You guys with me? This isn't so terrible, right? Bless you. 8-8. Purchase 8,000 units for $5.50 each. So here we have 8,000 units under purchases times $5.50. Where's your calculators? You guys with me? Sure? All right, now, here's what I like to do, and you can do this a couple of different ways. I'm going to definitely make sure that I separate what's going on here. So what I need over here is I need my new inventory balance. What did I have before this transaction? I had 2,000 units at $5.30 each for a total of 10,600. Now I have 8,000 units at a total of $5.50 each, right? Or not a total, at a price of $5.50 each, I should say. And so what do I have? I have 10,000 units at a total dollar value of $54,600. Does that make sense? And then I draw like a little darker line here so I know that that's kind of after, that's my evaluation after the 8th. You with me? Okay, what happens next? Sold 6,000 units for $12 each. I don't care about the $12 right now. When we come back on Tuesday, I'll show you the journal entries that go along with this, but for now, we're just focusing on the cost part. So my next date here is the 14th, and I'm not purchasing, am I? I sold something. So now I need to identify the cost of the goods that I sold. How many units were sold? 6,000. So if I'm going in chronological order, these are the units over here, my inventory balance. This is what I have available to sell. I sell a total of 6,000 units. What assumption do I make? Which units did I sell first? So I'm going to assume I sold 2,000 and we paid $5.30 for those, right? For a total of 10,600. What do I need to add? What do I need my total units to add up to here? 6,000. Said 6,000 units sold, right? Yes? Okay. So all these 2,000 are gone now, aren't they? They're gone. How many of the 8,000 did I sell? 4,000. And we paid what for those? $550. So 4,000 times 550 is what? 22,000. Yep. So 32,600 is the total value of my cost of goods sold. So I am going to show you guys something real quick here. If this is my journal entry for that date, okay? My debit to accounts receivable, my credit to sales are going to be for 6,000 units times $12 each, which is what? 72,000, right? Okay, thank you. Yeah. Everybody's watching the clock, right? 72,000. That's that journal entry. How much is this though? $32,600. Isn't that what I just figured out? Yes? Okay. So, what do I have left over? Yeah, I sold 8 of these. Now there are, and it doesn't matter where you write this. I usually write it on the last line that I have to line up. 4,000 at 550 for a total of 44,000. You with me? Everybody see where I got that? Look, we sold all 2,000. We sold 4,000 of these, which means there were 4,000 left. That's what my ending inventory is now. What did I say? Oh, no, it's half. You're right. I just wrote what I saw was looking at above. You guys are so kind. Dr. Seidel, you wrote the wrong answer down. Yeah, half of 44 is 22. It always has been, always will be.
How do you know, like, when you should, like, evaluate it? Like, when you go down, like, that whole list of dates and do everything?
So perpetual. After every, this is the thing. So periodic, we waited, if I go back to the example, the periodic, we waited till the end of the year and we did all totals. Here, we're doing after every single transaction because this is perpetual. After every transaction, I have to know how much inventory I have and how much I sold. Does that help answer your question? Okay, that's why we're doing it this way, by date. Under periodic, we just wait till the end of the year, we add up our total inventory, we figure out what was left, and then we give a value as a total. Here we're doing after every single transaction. So I'm gonna leave you guys with this. The next date is the 18th, right? And what do you do on the 18th? Purchase what? At? Right. So you see how this is gonna go? What's 6,000 times 560? I got 33,600, is that right? Okay, so what's in my ending inventory now? Don't forget to bring down what you still have in your inventory. You have 4,000 units, right? That you paid $550 for a total of 22,000. And now you have another 6,000 units that you just bought at $5.60 for a total of 33,600. So you have a total of 10,000 units that have a total value of 55,600. See how this goes? Guess what I want you to do for Tuesday? Finish it. I want you to do the rest. You got the listen, all you got are 2 more transactions. You got a sale on the 25th and another purchase on the 28th. That 31st, it says inventory on hand. That's just how much inventory you should have total left over after you get done with the 28th. That's not a transaction, that's just, hey, look, this is how much you should have left in your inventory balance, total units, not dollar amount units. So I just want you to try to do the last 2 transactions for me. Then on Tuesday, we'll do LIFO. Yes, Tracy. Oh, yeah, I'm sorry, dear. Page 439. Page 439. That's a good question. Page 439, exercise 814. Now, why should you do this? What page did I just tell you? Oh my gosh, my brain. Yeah, you're going to have a graded assignment. This is practice. All right, thanks, guys. Have a wonderful weekend.